Hello friends, I am CMO Gupta and today I will be discussing the new rate structure in real estate sector. So we will be covering basically rate structure, the conditions for the rate structure, the exemption pertaining to TDR and the ITC formula they have specified for this rate structure part. Okay, so we will be covering these four things in the video. Now coming on, so this change was proposed by GST Council in its 33rd meeting, which was held on 24th February 2019. They decided to reduce the rate for real estate from earlier rate of 12% or 8% to 5% or 1%. But they had one condition for this change, that ITC which was earlier available to the builders will not be available now. This change was made effective from 1st April 2019 and various legal notifications for the same have been issued on 29th March. The main notification which contains all the rates and condition is notification number 3/19 central tax rate. Now we will be covering first part, rate structure. So for deciding the rate structure, we will be bifurcating projects into various types because the rates are different for different kind of projects. So first categorization is residential and commercial projects. So first coming on to commercial projects, the earlier rate was 12% with the benefit of ITC, and now also the rate is same except in a certain case which we will be discussing later. So the rate is same as earlier regime except in a certain case. Now coming on to the residential part, let us first discuss what was the earlier rate. Earlier they had bifurcated residential part into two portions. First was affordable and second was other than affordable. So for affordable, what was the meaning of affordable? So they had specified some schemes. So if a house was approved under those schemes, an apartment was approved, then it was called as an affordable house or affordable apartment, and the tax rate was such. So for affordable apartment, the tax rate was 8% with the benefit of ITC, and for the residential apartments other than affordable, it was 12% with ITC. Now coming on to the rate structure which is proposed, which is actually implemented via this notification. So for that they have bifurcated project into two types, and such bifurcation is taken from RERA, Real Estate Regulation and Development Act, which came out in 2016. So they have used various definitions from RERA, so we will be referring to RERA often. So RERA basically uses the term real estate project or REP for all the construction projects. So it has bifurcated such real estate projects into two types. First type is residential real estate project or RREP, and the second category is remaining category other than RREP. So first category RREP, second project other than RREP. Now coming on to the first category, real estate project, residential real estate project. So further there can be three type of apartments in that project. First, affordable residential housing, for that the rate is 1% without ITC. Then residential homes other than affordable, for them it is 5% without ITC. And for commercial apartments also the rate is 5% without ITC. So for the RREP they have made an exception to commercial portion. They have given the concessional rate to commercial apartments as well, because in RREP, we have let us first see what is the definition of residential real estate project. The definition of residential real estate project is that the project in which up to 15% of total carpet area is commercial in nature. So basically residential real estate projects are those in which a very small portion pertains to commercial part. And if we talk practically, what are those? So let us suppose in a big society there are some small shops which are required for day-to-day functioning of the people. So those commercial shops are not basically for profit motive, they are an essential part of the project. So for that reason they have provided the concessional rate for that commercial portion as well. Now moving on to the next category, projects other than residential real estate projects. Again, the rate for affordable residential, it is 1% without ITC. For the residential other than affordable, it is 5% without ITC. And then for commercial portion, it is 12% with ITC. So if a project is completely commercial or total portion of commercial is more than 15%, the rate will be 12% with ITC. Okay. Now, one confusion is arising among many professionals regarding the rate. As we have talked, the rate have been reduced to 5% or 1%. But if you see the notification which we referred, notification number 3/19, for residential other than affordable, the rate written is 3.75. So in that regard, the notification is of CGST. So another same notification is there in SGST, which also specifies the rate of 3.75. So total comes to 7.5%. And then they've said that provisions of paragraph 2 shall apply for valuation of that service. So paragraph 2 says that out of the total value of the apartment, 1/3 value will be deemed as the value of the land. So when we see the effective rate of tax, we have to reduce that 1/3 part which pertains to land. So out of that 7.5%, I'll reduce 1/3 part. So the effective rate will come out to be 5%. And similar calculation goes for affordable housing as well. Okay. So we have discussed the basic rate structure. Now there are different rates for affordable and other than affordable. So what is the meaning of affordable housing or affordable apartment? So they have defined affordable apartment on the basis of two criteria. First criteria is size of the apartment. The size of the apartment should be up to 60 square meter if it is in metropolitan city, or 90 square meter if it is in non-metropolitan cities. And second criteria is value of the flat. The value of the flat should be up to rupees 45 lakhs. So if our apartment satisfy both of these conditions, then it will be called an affordable house and the rate of 1% will be applicable. Now another confusion might arise that what would be taken in value of the flat for determining the limit of 45 lakh, as there are various charges which are recovered by the customers from the builder. So they have clarified that all the charges will be included. So value of construction of the flat, value of the land, any ancillary charges which are recovered by the builder, like preferential location charges, development charges, car parking charges, club membership, or any other charges related to the flat, they all will be included for determination of the cutoff limit of rupees 45 lakhs. Okay, so we have concluded first part of our video. Now we will be coming on to the next part, which is conditions for opting such new rates. So before going into conditions, we will be discussing about the projects based on their timelines. So if I categorize projects on the basis of timelines, first category would come, that would be completed projects. So these are those projects for which completion certificate, CC, or first occupation, whichever is earlier, this event has happened up to 31st March 2019. So these projects were basically completed before the new rates came into force. So for these projects, the new rate will not have any implication. So suppose if there is a demand note, suppose the project is completed but some residual demand, say 5% or 10% of total demand is remaining, and those demand notes are raised after 1st April. So on those demand notes also, the earlier rate of 12% or 8% will be applicable, and no condition, no implication of ITC reversal will come on them. Now coming on to the next category, it is new projects. So basically those projects which starts on or after 1st April 2019. So those projects, for those projects, builder has to pay tax at the rate of 5% or 1% or 12% in case of commercial, and he has to comply with all the conditions they have given. So it is not an option for the builder that if he wants to go for the higher rate and avail ITC, it is not possible. He has to compulsorily go for the new rates, lower rates, and he cannot avail ITC and has to comply with all other conditions as well. Then the remaining category, it is ongoing projects, which does not come under above two categories. For that, the government has given option to the builder. He can go for the new rates if he want to go for lower rates, or he can also go for the old rates if he want to avail ITC for the project. So if a builder wants to opt for the old rates, he has to file an Annexure 4, which is given in the notification, by 10th of May 2019. So if you want to go for the old rates, you have to file that annexure by the due date. Otherwise, it will be deemed that you have opted for the new rates and you have to reverse ITC, which is given in the formula. So you have to take care especially of that. Now, what is ongoing project? Some litigation might arise in that too. So they have very clearly given 4 conditions which a project need to satisfy to be called as ongoing project. So first condition is that if any commencement certificate is required by any competent authority, that certificate is issued up to 31st March 2019. Then the next condition, it is certified by any architect or any engineer that construction has actually started on that project up to 31st March 2019. Then third condition, the completion certificate or the first occupation, whichever is earlier, this event has not happened up to 31st March 19. And then the fourth condition, the apartment under the projects, any apartment have been booked either partly or wholly, and its payment have been received by the builder in its bank account up to 31st March 19. So if a project satisfies all of this condition, then it will be called as an ongoing project on which builder has the option to opt for old rates or new rates. Okay, now coming on to the conditions which are given for the new rates. So first condition, which we have discussed many times in the video itself, ITC is not available to the builder. So for new projects, no ITC is available to the builder, and for ongoing projects, ITC is available to a specified extent, which is given in a formula which we will be discussing later in the video. Then next condition comes that all the liability of the project, residential project, have to be paid in cash only. So I will be taking an example to clarify both the conditions which I have discussed. So suppose there is a builder who has 2 projects. One is residential, on which he will charge 5% or 1%, and one is commercial project for which he will charge 12%. And he has not taken ITC for that residential project. He must be using materials. He has not taken ITC for that project. So there he has complied with first condition, and he has taken ITC for the commercial project, which is allowed. Now suppose after paying off the liability of commercial project, some ITC is left, some ITC is remaining, and he want to use that ITC for the output liability of residential project. So that is also not allowed. They have said that all the output liability pertaining to that portion or pertaining to the liability at the rate of 5% or 1%, that liability have to be paid in cash only. No ITC of any other project, any other business can also be used for that liability. Clear? So now moving on to the next condition. So suppose if the builder purchases any cement from any unregistered person, then builder has to pay tax on such cement under reverse charge mechanism as the recipient at the applicable rate, which is 28%. And the tax will be paid when he receives the cement as per the normal time of supply provision. So if he receives the cement in the month of August 2019, he will pay that by 20th September 2019. Okay. Now coming on to the next condition. They have given a condition that 80% of total purchases of the project should be from registered person. And if it doesn't comply with that condition, so let us suppose builder has purchased 70% of the total purchases from registered person. So there is a shortfall of 10%, 80% minus 70%. So they have said that builder has to pay tax under reverse charge mechanism on that 10% shortfall amount. And what will be the rate? Because there would be various goods and services which you have received from unregistered person. So they have given a standard rate of 18%. So builder does not have to see individual rate for every goods and service. He has to pay tax at the standard rate of 18%. Now the next question might arise, what would be the period for which a builder will check whether 80% have been achieved or not? So this accounting, first of all, it will be done project wise. So for every project, builder has to separately see whether 80% cutoff is achieved, and this have to be seen on a financial year to financial year basis. So during a particular financial year for a particular project, if a builder has not achieved the 80% threshold of purchases, then he has to pay tax on such shortfall at the rate of 18% by 30th June of the next financial year. So if I talk about financial year 1920, let us say there was a shortfall of 10%, then builder has to pay tax on such shortfall maximum in the return of June 2020. Okay, so this was all the conditions, and another condition is there for TDR, transfer of development rights, which we will be discussing in detail now. So coming on to the third part of the video, which is transfer of development rights, TDR. So let me first clarify one thing. They have given various kind of things. They have talked about TDR, transfer of development rights. They have talked about floor space index, FSI, and they have talked about lease by way of premium, salami, and various other things. So all those things, the taxability, the law is same for all those things. So we will be discussing them, and I will be using the term TDR for all of them. So whenever I say TDR, I mean all of the given things. Okay, so let us understand the taxability with help of an example. So let us say there is a landowner and there is a developer or builder. He approaches the landowner and he says that I am interested in your land. I will be developing a project on your land of 100 flats. So you give me the development right for those lands, and against those rights the builder will give 40 flats to the landowner and he will keep 60 flats for himself. So builder will sell those 60 flats to some buyers, and the landowner, he can choose to sell those flats as well, or he can keep the flats to himself. It is his choice. Okay, so two transactions will be happening. First of all, the landowner will be transferring TDR to the developer, and developer will be transferring those 40 flats to the landowner. So another condition which they have given is that the builder has to charge tax on those 40 flats which he is giving to landowner against TDR. So he will be charging tax on those 40 flats at the rate of 5% or 1%, as the case may be. Now another question might arise, what will be the value of those apartments, since the consideration is in kind, so there is no exact value. So whenever those flats are transferred to the landowner, fair market value will have to be seen. So suppose the apartments are transferred on 20th May 2019, and on 10th May a similar flat was sold to any other person, an independent buyer. So for the value on which flat was sold to the independent buyer, same value will be taken for valuation of those flats, and tax will be paid by developer. Now coming on to the landowner, what will happen to the landowner? He has paid tax to builder on such flats. So landowner can get ITC of such tax if landowner charges GST on his output sale of flats. So if landowner sells his flats, his 40 flats, before receipt of CC, then he will charge GST on such sale, and he can get ITC of such tax which was charged by the builder, and such output liability shall be at least equal to the ITC which the landowner is getting. Okay, so this was the basic concept. Now we have covered the first transaction, which is sale of flats by builder to the landowner. Now coming on to the second leg of the transaction, which is transfer of TDR. So this transfer of TDR attracted some issues in the past as well, in service tax regime as well as GST regime. So the government has clarified its position now. So the TDR is taxable. The rate would be 18%, and tax on such TDR would be payable under reverse charge mechanism by the developer. So it will not be payable by landowner. Even if the landowner is registered, the tax will be payable by developer under reverse charge mechanism. So the developer will pay tax on both the transaction. He will pay tax on flats under forward charge, and he will pay tax on TDR under reverse charge. Now what will be the time of supply when he have to pay tax on both these transactions? So government have given a special time of supply provisions on both such transactions. So they have given that whenever builder gets completion certificate or its first occupation, whichever is earlier, so whenever this event happens, then time of supply will come for both the transaction and builder has to pay tax on both of the given transactions. Okay, so this was all the flow about TDR. Now they have given one relief also. They have given exemption to TDR because builder will not be getting ITC for the residential apartments. So government has given exemption to the TDR. Now we will be understanding that with help of an example as well. So suppose builder was constructing 100 flats in total. Now out of those 100 flats, 80 flats are residential and 20 flats are commercial. And we will assume the carpet area of each flat is same. So if we take ratio of carpet area, it will also be 80:20. And let us suppose the value of the TDR is 1 crore rupees. So 80% portion is residential and 20% portion is commercial. So they have given exemption to 80% portion of TDR. So out of those 1 crore, 80 lakh value will be exempt and tax will be payable on 20%, 20 lakh, which pertain to commercial portion. Now out of those 80 flats, let us say 50 flats was sold before receiving the completion certificate and GST was charged on that, and 30 flats were unsold on that date. So those flats will be sold after completion of the project and GST will not be charged because it has become an immovable property. So government have said that for 30 flats, tax is also payable on those 30 flats because we will not be getting output GST on such flats. So on those 30 flats also, tax is payable by the builder, and such tax will be value of TDR pertaining to that 30 flats. So it will be 30 lakhs into 18%, or it will be 1% or 5% of the value of those 30 flats, whichever is less. So we will calculate both of these values and the builder has to pay tax with that amount which is less of these two values. So this is to make sure that the flats which are sold after CC, they are not unnecessarily inflated. टैक्स की वजह से उनका प्राइस बहुत ज़्यादा हाई ना हो.